Money and metals for the week ending May 8th, 2015. First, in the dollar and currency news, the dollar is mostly little changed against a basket of major currencies last week. The U.S. Labor Department data shows non-farm payrolls increased 223,000 last month, while the unemployment rate dropped to a near 7-year low of 5.4%. However, there was some interpretation, quoting, "I definitely think there's a degree of uncertainty as to what this report actually means," end quote, said Mike Meyer, Vice President of Everbank World Markets in St. Louis. He said the downward revision for March payrolls, in addition to ADP data released May 6th, showing a downward revision to private payrolls growth for the same month, were casting a shadow on this report. The market is somewhat long dollars, said Sebastian Gailey, foreign exchange analyst at Societe Generale in New York. The sterling was up 1.1% against the dollar at 1.54, not far from a 10-week high against the greenback after Prime Minister David Cameron won an election victory in Britain. In other currency news, President Barack Obama on Friday pushed back against trade critics who argue a trade deal with Asia will not do enough to prevent currency manipulation in China. Obama stated, "We're going to keep on going after them," in a speech given at Nike headquarters, saying that his administration's diplomatic work on the issue with China had helped to address the problem and it would continue. Looking at the gold market, gold retained losses from the previous two sessions on Friday. Mainstream reporters expected the Fed to raise rates at its June policy meeting, but we know that recent batch of mixed economic data has pushed those expectations out to later in the year. Personally, it seems there's room to raise rates, with the possibility of this doing more damage to the stock market than the gold market, in my view. In my studied opinion, the uptrend for the stock market is under pressure and could be going neutral to down short term. This would lead to a major reason to hold off on any interest rate increase, although it's very rarely stated in the mainstream financial press. Bond yields in Europe and the United States have been rising as deflationary fears have eased while recovering oil prices take hold. The other big news last week was that online platform BitGold will go public in Toronto and it is seeking an Asia listing. I met with some of the principals recently at the PDAC, Prospector Development Association of Canada, about the BitGold program. It's clear the company wants to have a global reach with its service, which acts as a savings account and a means of payment using gold as the quote-unquote currency. The company has arrangements with Brinks, and it has vaults in Toronto, London, Zurich, Dubai, Singapore, and Hong Kong. Users are able to redeem gold and have it shipped home. Investors include Soros Brothers Investments, Sprott Incorporated, Power One Capital Markets, and Sandstorm Gold, which brought it to my attention. Soros Brothers owns 6% of the company. BitGold's investment banks are Dundee, GMP Securities, Canaccord, and Claris. And moving on to the silver market, silver prices on average have declined 14% this year as speculation that the Federal Reserve will raise interest rates spurs a shift to alternative assets, according to GFMS. Silver dropped to $16.50 an ounce. They're talking about the average price for the year versus $19.08 in 2014, according to Andrew Leland, manager of precious metals demand at Thomson Reuters GFMS. In 2014, a physical demand declined of 4.1% to 1.07 billion ounces from a year earlier, as purchases of coins and bars fell from a record high, according to the report. Industrial fabrication, which includes silver used in electronics, photography, brazing alloys, solders, and a myriad of other applications, dropped about 0.5% to about 595 million ounces, according to the report. In 2014, most primary silver producers refrained from hedging, while silver companies locked in the price of silver that was mined with the base metals. For the base metal producers, this is a very small part of their revenue stream, and it helps to lock in the price according to GFMS. It gives them more certainty, obviously. And I'd like to finish off this week with a quote from Stephen Roach, Yale University economist, who worked at Morgan Stanley's agent desk and one of the most quoted and renowned economists out there. And he says, I quote, "The easy money antics of the Federal Reserve and other central banks are delusional and bound to lead to a global crack-up. The big bazooka of quantitative easing has led to inflation of assets like stocks and encouraged currency depreciation, ingredients for a disaster." And that's a wrap for this week in Money and Metals.